Right. Let's take a moment to really understand what's happening here, because this isn't just another headline or a routine market blip. This is a full-blown financial emergency, and the warning lights are flashing brighter than ever. Let's talk about the United Kingdom, a country now facing a financial emergency so dire that Wall Street's biggest players have issued a code red. This isn't hyperbole, it's a rare, urgent signal from the world's most powerful financial institutions. And it means the stakes couldn't be higher for Britain's economy, its people, and anyone with money tied to the UK. This isn't just one nervous bank. It's JP Morgan, Goldman Sachs, and Morgan Stanley all sounding the alarm. These are the titans of global finance, the institutions that shape markets and influence governments. When they speak in unison, the world listens, and right now, they're all saying the same thing. Britain is in trouble. When these giants coordinate, it means the UK economy is teetering on the edge of a major recession. Behind closed doors, boardrooms are filled with anxiety. The data is grim: falling growth, rising debt, and a sense that the next misstep could trigger a downward spiral. The mood among executives and analysts is one of deep concern, bordering on panic. The warning? A catastrophic consumer spending freeze is coming. Brits are about to clamp down on their wallets like never before. This isn't just about people spending a little less, it's about a nationwide halt in spending, with families forced to make impossible choices between essentials. The high streets, once bustling, are now eerily quiet as uncertainty takes hold. Wall Street's message to investors is crystal clear: get your money out of the UK or risk losing it. The advice is blunt, and it's sending shockwaves through global markets. Investors are scrambling to move their assets, and financial advisors are fielding panicked calls from clients desperate to avoid the fallout. The British consumer, after years of being squeezed by rising prices, stagnant wages, and relentless bills, is at a breaking point. For many families, the pressure has become unbearable. They're cutting back on everything: holidays, dining out, even basic groceries. The sense of financial security that once defined the British middle class is evaporating. Imagine the UK economy as a Jenga tower. One more piece pulled, and the whole thing could collapse. Every decision, every policy misstep, every shock to the system threatens to send the entire structure tumbling down. The tension is palpable, and everyone is holding their breath. The next piece? A freeze in consumer spending, setting off a chain reaction. When people stop buying, businesses suffer. When businesses suffer, jobs are lost. And when jobs are lost, the cycle of decline accelerates, pulling more and more people into hardship. The first signs of this collapse are already starting to show. Storefronts are shuttered, job losses are mounting, and the mood on the street is one of fear and uncertainty. Britain is standing on the edge, and the world is watching to see what happens next. The first casualties, not some obscure, struggling startups or niche brands you've never heard of. No, the shockwaves are hitting the giants first. Tesco, Marks & Spencer, and Sainsbury's. These are the titans of the British high street, the household names that have shaped the way the UK shops for generations. Their logos are as familiar as the Union Jack, and their stores are woven into the daily routines of millions. But now, Wall Street is dumping their shares at a pace not seen in years. The message is clear. Even the most stable, time-tested retailers are suddenly being viewed as high-risk investments. The confidence that once surrounded these companies has evaporated almost overnight. These companies aren't just stores, they're the heartbeat of British consumer spending. If they're in trouble, it's not just a corporate problem, it's a national crisis. When the pillars of the high street start to wobble, everyone feels the tremors, from suppliers to shoppers. Analysts are sounding the alarm about a catastrophic drop in consumer confidence. People are scared. Every trip to the supermarket is a reminder that bills are rising, paychecks don't stretch as far, and the cost of living crisis is biting deeper than ever. Shoppers are scrutinizing every item, weighing needs versus wants, and often putting things back on the shelf. The recent downgrades aren't just numbers on a spreadsheet. They're a loud, unmistakable declaration. The British consumer is running out of cash. The financial lifeblood that keeps these retail giants afloat is drying up, and the warning signs are everywhere. It's not just luxury items or treats being cut back. Even essentials, bread, milk, fruit, are being left behind. Families are making impossible choices, prioritizing heating over eating. and the impact is visible in every empty basket and every abandoned shopping list. This is the financial equivalent of a doctor checking a patient's pulse and finding it dangerously weak. The signs of distress are everywhere, and the prognosis is grim unless something changes fast. The message from the markets is stark. No part of the UK economy is immune. From the glitzy financial district to the smallest village shop, uncertainty and fear are spreading. The very foundations of the consumer economy are crumbling. What was once rock solid is now riddled with cracks, and the future of the high street has never looked more uncertain. The party's over. The era of easy spending and endless growth has ended, and the hangover, the painful reckoning, has only just begun. Why now? The UK is being battered by a perfect storm: high inflation, rising interest rates, stagnant wages and sky-high energy bills. Inflation is eating away at savings and income, while the Bank of England's rate hikes have made mortgages painfully expensive. Wages aren't keeping up, so households are squeezed from all sides. The result? People have less money and are forced to cut spending everywhere. Even with government support, energy bills remain crushing. Families are choosing between heating and eating. The consumer isn't just cautious, they're paralyzed. This is the engine driving the looming economic collapse. If you need proof that the British consumer is truly running on empty, look no further than the high street this Christmas. The signs are everywhere, and nowhere are they more obvious than at Card Factory. Card Factory is a staple of the British retail scene, known for selling affordable greeting cards, wrapping paper, and small gifts, items that, in better times, almost everyone would pick up without a second thought. But this year, in the middle of what should be their busiest season, Card Factory stunned the market with a shock profit warning. For a retailer that relies on Christmas to make its year, this is nothing short of a disaster. When shoppers are hesitating over a 150 card, or leaving it behind altogether, it's a clear sign that wallets are squeezed tighter than ever. People aren't just skipping luxuries, they're cutting out even the smallest, most affordable treats. The market reacted instantly. Card Factory's shares plunged, sending shockwaves through the retail sector. If even the shops selling the cheapest goods are in trouble, what hope is there for the rest? This isn't about people putting off big-ticket purchases like TVs or holidays. It's about families and individuals deciding they can't justify spending a couple of pounds on a card or a small gift. The cutbacks are hitting the basics. Card Factory has become the canary in the coal mine for the UK economy. And right now, that canary isn't just looking unwell. It's flat on its back, warning us all that something is seriously wrong. Retail sales across the country are slowing, and consumer confidence has sunk to levels not seen in years. The mood on the high street is grim, with shoppers more cautious and retailers more desperate. The pain isn't just in the headlines, it's visible in everyday transactions. Fewer people are making purchases, and even the smallest sales are drying up. When cheap, mass-market items like greeting cards and stocking fillers stop selling, it's a sign that the very foundation of the consumer economy is starting to crack. The warning signs are everywhere, on the high street, in the financial pages, and in the empty aisles of stores that once bustled with Christmas shoppers. The canary is dead, and the message couldn't be clearer. It's time to pay attention, because the trouble in Britain's shops is a warning for us all. Why does a consumer spending freeze matter so much? Because the UK economy runs on consumer spending. When people stop buying, retailers' profits and stock prices crash. This triggers panic selling, spreading fear to other sectors: pubs, restaurants, travel, fashion. As stock prices fall, people feel poorer and spend even less, creating a vicious downward spiral. The downgrades of Tesco, M&S, and Sainsbury's are the trigger. Panic selling takes over. Logic goes out the window. Wall Street's code red is both a warning and a catalyst. The first domino has fallen. The rest are lined up, ready to go. The meltdown has begun. Financial crises never stay contained, they spread. The pain in retail is already infecting UK banks and real estate. When consumers default on loans and mortgages, banks face huge losses. Financial stocks are now high risk, with lenders sitting on a ticking time bomb. The housing market is under stress. High rates and squeezed consumers mean falling prices and forced sales. Real estate companies and home builders are bracing for a nightmare. The domino effect hits every corner of the economy, from car makers like Jaguar Land Rover to small business franchises. Even minor scandals, like W.H. Smith's accounting blunder, add to the panic. Every bit of bad news pushes the dominoes further. The contagion is spreading fast. No sector is immune. Here's what to avoid. Tesco, M&S Sainsbury's, and the entire UK retail sector. If a company relies on Brits spending money, it's radioactive. Fashion, electronics, furniture, pubs, restaurants, none are safe. Card Factory's warning was the ultimate red flag. Add to the list. Banks lenders, exposed to UK consumer credit and mortgages. Defaults are set to rise, and smaller lenders could face disaster. The real estate sector is also in the danger zone. Home builders, REITs, estate agents. High mortgage rates and low confidence mean a housing crash is possible. If a company's success depends on the British consumer, steer clear. In this storm, capital preservation is key. What should you watch for next? The Bank of England is under pressure. An emergency rate cut could be coming. Any move they make will send shockwaves through the market. Watch for more profit warnings from retailers. If Card Factory was just the start, things will get worse. Keep an eye on inflation, retail sales, and consumer confidence data. If inflation stays high and sales keep falling, we're in stagflation territory. The Bank of England could be trapped, unable to cut rates or hold them high. The next few weeks are critical. The storm isn't over. Brace yourselves. Wall Street's alarm is blaring, and the UK economy is on the brink. The combination of inflation, high rates, and stagnant wages has frozen consumer spending. The downgrades of retail giants and Card Factory's collapse are just the beginning. Contagion is spreading from retail to finance and real estate. Now is the time for extreme caution. Don't try to catch the bottom. Review your portfolio and avoid high-risk UK sectors. Watch the Bank of England's next move and upcoming earnings reports. This is a fundamental breakdown in the UK's economic model. Don't be left holding the bag. Heed the warning and act accordingly. When Wall Street screams, it's wise to listen.